This timer runs out very fast, whereas this one takes much longer. That's the secret behind the calendar spread. We're going to sell the one that runs out fast and buy the one which is going to stay longer. Hi, I am Pranav VK, your strategy expert here at Stockshaala by Kotak Securities. So far, we have discussed different types of strategies, but all of them were ending on the same expiry date and you were looking at the same underlying asset. But moving forward, we are going to look at the same underlying asset but expiries of different time frames. A calendar spread is also called as a time spread. In this case, you will be trading in the same strike but with different expiry dates. The setup looks something like this, where you're going to sell the near-term option and you're going to buy the same strike for a later expiry. The goal of this setup is to earn money from the shorter option where it's going to decay because of time, whereas you're going to retain the one which is going to have value in the longer term. Let's look at a Nifty calendar spread to understand this concept better. Here I've taken Nifty to be at 19,500. So all we have to do for a calendar spread is that we have to sell the near strike, which is near the expiry, weekly expiry, that is 19,500 call option ATM at just rupees 40. Whereas I'm going to buy 19,500 call option, which is a monthly expiry, which is maybe 3 weeks away and which is trading at a premium of rupees 80. So this is a net debit spread. So in this case, you're receiving 40 and paying 80. So the net debit is around rupees 40. In this strategy, you're going to make maximum profit if Nifty stays around this range at the end of the weekly expiry. Here's a quick analogy to help you understand this better. It is like subletting a property for the short term while you still hold the long-term lease. Here are 3 reasons why calendar spreads work. Number 1, theta works in your favor, which means the short-dated option is actually going to decay worthless and you're going to get the entire premium. Second is the Vega benefit. If IV increases on your long-dated option, then your position is going to retain the value. Third is if the market stays near the strike price, then you make a profit. But here are the things that can go wrong with this strategy. Number 1, if the market moves away from the strike price significantly, then both the options lose. If IV falls on the farther dated options, then the farther dated option will lose value. This is a net debit spread, which means you've already paid the premiums. So the extent of your maximum loss is also limited to the premiums paid. This strategy is best to use when IV is low and expected to rise. Number 2, when the market is range bound. And number 3, you want a non-directional limited risk strategy with less capital requirement. Don't use this strategy during big event weeks as well as expiry days. So let's summarize what we have learned so far. We understood that a calendar spread is when you are selling a near-term option whereas you're buying a farther-term option. We also learned that a calendar spread is also called as a time spread. And finally, you want a non-directional limited risk strategy which also requires low capital. Hope you liked this video. Go ahead and share this with your friends because in the upcoming video, we are going to talk about weekly expiry tactics where we are going to learn about how to trade like a pro on expiry days using straddles, strangles as well as spreads along with adjustments. You're watching Stockshaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.